Good morning, trading world. It is June 23rd, 2023, and this is, I guess I shouldn't call this a pre-market outlook because I don't go fully in depth, but these are just thoughts and things that I wanted to address this morning since I unexpectedly ended up being in front of a screen this morning. So let's get to it. The title for this morning's pre-market, or my thoughts, whatever you want to call it, is the market is sitting on the edge of a cliff with a bungee cord attached to it. So, as you know, I haven't been in front of the screens a lot this summer, but I wanted to give a quick update of what I was thinking about the markets at this point. I came into the week with more than a few short positions on. I was looking for an exit between 434 and the 429 area on the SPY. For the most part, I have achieved those exits. I still have a couple positions on that will roll to risk out because I am still looking for a pop down below 430. I didn't want to be greedy waiting for those last few points, knowing it could skyrocket back up at any point after the test below 430. However, I still want to get long on a bounce coming back through the 430 area. This 430 area is going to be tricky because a couple of things could happen below it. One, we could test below 430 and the bungee cord takes hold right away and we bounce like a rocket immediately. Two, there's a lot more slack in the bungee cord than I thought, and we fall down to test the major channel boundaries around the 425 area. Maybe even dip our toe in the channel below close to the 420 area just to check the temperature and scare a lot of people out of long positions. I want to get long, but I need to see a favorable reaction on the 4-hour and daily chart, and this could happen lightning fast. This may be another options on futures play and the immediate exit if the action below 430 acts funny in any way. So, as you can see, we're on the edge of the market maker's expected move for the week. And if you follow me at any time, you definitely understand that this is where things will and can get crazy. So we're right on the edge of crazy. Also, real quick, I want to address the VIX and how to look at the VIX for someone. Now, we were all taught that the VIX is a measure of fear. It does not have much to do with trend direction. As you will see soon, especially in a wild bear market rally, the VIX will go up just as fast in a rally. It measures the put activity as a function of volatility in the S&P 500. Most often, puts are used for insurance to hedge long positions by large portfolio managers. Let me bring up a chart of VIX. Okay, now here's a 5-year look back on the daily on the VIX. everyone knows I like to kind of explain things using common items or analogies. So everyone's seen a scary movie. And if you've ever watched a scary movie, it's always the quietest right before the axe murderer jumps out and starts killing people. Also, in scary movies, there's a level of activity where you also feel safe when everybody is out walking around, so you feel a bit safer. Then there's the super scary moment where you're running for your life. So, thinking about the VIX, there are moments like now when it's too quiet. This is when you want to make sure all the doors are locked and ensure that you are in a safe place. This is where we are now. If you can see on the chart, this is the lowest that we've been on VIX in a long time. And you can see back here, we don't really stay down there long. So again, this is the time to ensure the safety of your portfolio or the safety of your profits that you've gained throughout the year. This is the time to hedge and protect. Now, this area that's on the VIX between 7 and 14, this is that area that's too quiet. And you have to be on high alert. So let me mark this area. This all right, as you can see, this highlighted red area is where you should be on high alert because it is too quiet. Time to ensure safety. Then you have the 15 to 18 area. Now in this area, danger is lurking, but I feel a little bit better because of the amount of activity going on in the market. All right, we're going to mark that 15 to 18 area with the regular box shadow. So this is where we feel better, like we can be out, we can be active, we can jump in and out of positions because there's a lot of activity going on and we can kind of see things a little bit better. You don't have to feel as scared because there's so many more people out moving with you or traders out moving with you. And one of the things that you'll notice when you're down here in this area where it's too quiet, go take a look at the volume. And usually around this area, the volume will have an extreme drop off. And this kind of lets you know it's not safe to be out. Even if it's rallying or whatever it's doing, it's too quiet. Something's up. All right, now this next area, 19 to 24 on the VIX, danger is just around the corner. It's ready to jump out and kill your account if you're not ready. So a lot of people, start trying to do hedges. These are the late hedgers and late profit takers trying to wait to the very last minute in this area. So, again, the 19 to 24 area, that axe murderer, he's lurking and is just around the corner. All right, above 25, you're pretty much running for your life. If you hadn't made any changes to your positions, to your portfolio, to hedge or ensure safety, you're definitely running for your life above the 25 area on the VIX. Now, as noted by the extreme shade of red, the 35 plus area on the VIX. If you didn't take steps to ensure your safety at the levels before, your account is now dead. There's no escaping it. It's super extreme at these levels. 3, 4 sigma moves at this point that no one is safe from. Now, at these levels, there are those bold traders who like to come out and play around these levels with specific risk strategies. I am one of those people, but that is a whole nother conversation. But for now, I hope this kind of explains how you should be looking at the VIX and not using it as some form of trend measure. The VIX measures volatility, and volatility can happen to the upside. Even though it's rare, it can and will happen to the upside. So, again, this is how I see the VIX. And when we're at these super quiet levels, this is when you should be taking the time to ensure your portfolio or your account's safety for moments of extreme VIX. So, again, as I always preach, your most important job as a trader is to protect the capital that you already have. We do this by knowing and understanding the risk that we have on in our positions and knowing the risk in the current market conditions. I hope this helps. Wishing you a positive trading day. Let's go out and make it a great one.